Please note that the information on Retire Vivid referenced in this video is accurate as of June 28, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. The information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And today's episode is about taxes. Diversification isn't just about investment performance. You also need to look at diversification when it comes to your tax strategy. Because one of the questions that a lot of our clients ask us is, how do I save money in taxes? There are strategies that are out there. The question is how do you do it? I'm excited to go through it.
In retirement, we'll get into Social Security, the different account types you have, but you have some control over the amount of taxable income you can put on you can show, just depending on income need and all those things. But you have that control, and so it's really important to get into pre-planning prior to retirement and just figure out where everything is at.
I mean, everybody has these different tax buckets, and we're going to talk about the big five here in just a minute. But the point is everything's taxed differently. So everybody has a different retirement income need at retirement. All right, so here's that need. The question is which lever do you pull? Meaning, which tax bucket do you pull from? Do you pull it from just one? Do you do proportion across the board? We're going to talk about that in terms of a strategy. But it's not just that, Tommy. It's also what tax bracket are you in? And then where will you be when you retire?
Most people are sitting there thinking about or probably considering a withdrawal rate or how much money they need out of their accounts.
Right.
Taxes become a drag on that because as more is shown as taxable, you're taxed at higher rates. That's more you have to take out of your accounts to cover that. I've yet to run into somebody who wants to pay more taxes than they need to. And so today we're going to discuss, some opportunities to be tax efficient within that.
That's exactly right. Because when you talk about a withdrawal rate, that's what you're pulling from the portfolio to live on. But that's just a withdrawal rate. Are you including taxes on that? There's also tax laws that we have to be aware of, especially from the federal level and from the state level. So Tommy, let's talk about the big five. I want to first talk about tax-deferred accounts. If you take a look at where most people's wealth is, it's usually in their home in these type of accounts. And so this is the 401ks, IRAs, you name it.
Tax-deferred, and specifically the pre-tax portion of those, that's money you've taken a tax deduction going in. It's grown tax-free 100% reportable as income when you take withdrawals from it. In the last piece, even if you aren't taking withdrawals from it, you're going to hit an age where the IRS says you have to take your required minimum distribution. And that's a percentage of the account. The percentage grows each year as you age, but that amount has to come out of the account shown as taxable, regardless if you're using it for income or not.
To your point, I mean, we've been feeding these things for years, right? Because you got that tax deduction going in, but coming out on the flip side, because there's an arrangement that you have. I mean, that's what an IRA is. So it's going to be taxed as ordinary income. We call this 1099 later money. To your point, you just said required minimum distributions. And so, that's depending on, the viewers that are listening, 73 is the RMD for a lot of folks, but it's 100% taxable. Let's move on to one of our favorite buckets, and that's what we call 1099 never money.
1099 never, yeah, that's your Roth or after-tax portion. That can be in an IRA, or if your employer-sponsored plan, 401k, 403b, whatever line of work offers that option. That's money that you do not receive the tax deduction going in, but it has grown tax-free and then will come out tax-free.
Pass on
forever.
tax-free.
Pass on tax-free.
Yeah.
Great benefit if it makes sense for you to get into one.
But what's the downside? You got to pay tax first, right?
Taxes going in.
But on the flip side, it's tax-free, to your point, forever. Well, it's funny, Tom. I mean, we work with a lot of people, and so a lot of people come to us and say, boy, I wish I met you guys 10 years ago, because they go, that's how we were taught, right? That's how we were taught. Feed those 401k plans, because what they say is, hey, you're going to be in a higher tax bracket, while you're working, so get that tax deduction. But then when you retire, you're supposed to drop because you don't have that W-2 income anymore. But what about people that were good savers?
Yeah, I mean,
right?
And for those accounts, depending how they're invested, if they've been there for 25, 30, 35 years, you can get to a level where, looking forward to required minimum distributions, that amount is more than you need for income or that you're planning to take. Right. And so it's important to, evaluate if you are still contributing to those accounts. You tend to get more benefit to a Roth when you're in the lower tax brackets. When you're in the middle, you can consider splitting contributions just to diversify taxable income later in retirement. And then most likely, if you're in the highest tax brackets, you're probably not going to be in that in retirement. And so it may make sense to go the pre-tax route, take the deduction,
right,
and then pay taxes coming out.
Or split it, like you mentioned. I mean, it just depends, because again, we're just doing a blanket across the board. We love the Roth. The question is, does it make sense for you? Okay, so let's move on. The next one is a taxable investment. We call that 1099 now money, right? That's that windshield wiper effect, meaning you make money, you pay taxes, you make money, you pay taxes. That's your capital gains, your dividends, you name it.
So if you have, an individual or a TOD or a joint or a revocable trust account, those spit off the 1099 now, generate a 1099 every year if transactions happen in the account. Within that, you have options on ordinary dividends or qualified dividends. You have ordinary interest. You have short-term capital gains if you sold something for more than you made it. You have long-term cap gains, and those are taxed differently. So, evaluating, the asset level, the intent of that type of account, if you can get to a long-term tax holding, if you review the holdings within there and look for more qualified dividends versus ordinary, depending on your tax rate. A lot of options within that, but ways to be tax smart about it.
There's also harvesting that you can do as well too, especially, and we just talked about this in terms of what bracket you're in, because if you are in those lower tiers, there's a potential that you could pay no tax on that qualified or long-term capital gain rate, which is a really cool thing. But again, but you gotta be aware of where you're at in terms of a tax perspective. The next one I really like too, and I really hope people take advantage of this if it's offered, HSAs or health savings accounts.
If there's one thing we've seen keeping up with inflation, it's the cost of medical care.
Oh, you're not kidding.
And so health savings accounts, HSAs, provide a great benefit. If they are used for qualified medical expenses, they can be triple tax-free. So tax deduction going in, tax-free growth, tax-free coming out for those qualified medical expenses. If that account has gotten too big, you can't use it for medical expenses, or you're not going to use all of it, it just becomes a traditional IRA at 65. Mm-hmm. And so it's really no different than that pre-tax 401k traditional IRA. if you're not using it. But if you are able to use it for those qualified expenses, becomes a great benefit.
There's also rules out there where you could take monies from an IRA and transfer that into an HSA, depending if unless you're you have to be in a high deductible plan where you pay no tax. That's a one-time deal. I mean, there's a lot of things you can do with an HSA, which is a wonderful component when it comes to, and I'm glad you mentioned that, because when it comes to health insurance, premiums and things like that, we're going to have that for the rest of our life, right? And so if you're able to offset some of that, why not? Next is Social Security, one of the largest and biggest decisions a lot of people are going to make during retirement, because the pension days, they're basically over. You know, unless you're a federal employee, you get a pension. If you have IPERs here in the state level, you get pensions, but a lot of people don't. They have their 401ks, their IRAs, and they have their Social Security, but you do get a wonderful tax preference with your benefit.
Yeah, it gets its own section of the tax return. It's within a provisional income formula. And so half of the Social Security benefits go in, all other reportable sources of income are included in that. And then it determines how much of your benefit is taxable. So there are ways to pay, basically 0% on your Social Security benefit, depending on other sources of income. It can go up to 85% of that benefit being taxable.
And this is why we're doing this show. We're going to show you how to put the tax diversification in motion right after the break. Make sure you stay with us.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. If you just joined us, we're talking about tax diversification. Really, how do I save money in taxes? And so now we're going to be putting that into motion. I want to touch on Social Security first, because this is such a big milestone when it comes to retirement, because like we already talked about it, the pension days are basically over, and this is a retirement paycheck for life. But you get a tax preference with it, and we utilize it quite a bit in terms of how you save money in taxes.
Briefly mentioned earlier, but you can pay 0% federal taxes on your Social Security benefit. You can pay 50%. You can pay up to 85%. And so, we can spend an entire episode on Social Security and the claiming decision, but you have at 60, for most people, you have at 62 an age-based reduction. That amount increases to your full retirement age. You get delayed retirement credits up to 70. So it's really important to evaluate as you're looking forward on tax efficiency, diversification of income sources type of things, incorporating that Social Security decision. But in our example, we have here a married filing jointly, needs $60,000, and they have higher Social Security benefits, have made the decision to delay a little bit, or one delayed, one claimed early, and are able to get that full $60,000 income need from their Social Security benefit.
Right.
In this example, they pay 0 in federal taxes, and then 0 here in the state of Iowa.
It just shows you, so here, $60,000, $5,000 a month, and they pay nothing in terms of taxes. What causes Social Security to become taxed, because to your point, it goes through its own formula. It's a provisional income formula. The more pressure that gets pushed in terms of on the tax return, withdrawals from, and we'll talk about this, causes your Social Security to become taxed. So let's move on to another example, Tommy. We were talking about these buckets. Let's talk about the 1099 now money. This is the taxable bucket. This is the capital gains, the dividends, in terms of how that impacts Social Security.
Yeah, so 1099, and it's really important to evaluate between, the ordinary interest, ordinary dividends, short-term capital gains, and those longer-term capital gains or qualified dividends. So for an individual who still needs that $60,000, have $40,000 in Social Security benefits, and have the difference, $20,000, in either a long-term capital gain
Or a qualified dividend.
or a qualified dividend off of that account. Again, getting to that, they pay 0 in federal income taxes.
0 in federal income taxes. And again, we talked about this. It comes down to the tax brackets. What bracket are you in? Because that plays a role with long-term capital gain rates. And so that's why it's so important to be working with people that have done this before in terms of, okay, yes, investing is investing, but it's also you need that tax diversification to reach your retirement needs. So that's pretty powerful stuff. Let's keep going. So let's utilize the IRA withdrawals because that's a big one in terms of how the Social Security is taxed. So let's talk about this example.
Yeah, typically that traditional IRA or the pre-tax 401k is, typically the largest asset, investable asset. And so people are looking at that to supplement income. So we have that same couple, $60,000 income need. Couple A has a smaller Social Security benefit, elected earlier, doesn't matter, but they're receiving $20,000 in Social Security benefits, supplementing to get to that $60,000 income need with $40,000 from their traditional IRA. In that instance, they owe just under $2,200 in federal taxes.
That's still not a horrible deal.
Not a bad deal.
It's still not a bad deal because again, here in Iowa, if you're over, there was a law that was passed, House File 2317 here in the state of Iowa. Meaning if you're 55 and older, you don't pay any taxes, state tax on IRA distributions, pensions, that sort of thing. So, and there's no state tax on Social Security here anyway. But still, Tommy, that's still not a bad plan, right? And so let's move on to another couple where they both needed the same income, but they took a different route to get there.
Right, and that's where we'll get into reviewing for Roth conversions and RMDs, those numbers later. But in this instance, a couple took $40,000 in Social Security benefit, maybe delayed, had a higher benefit, and only needed $20,000 from their IRA to get to that $60,000 income need. In this instance, they will pay 0 in federal or state income taxes.
That's huge. That is huge.
It's a great benefit. It's a savings.
It's a huge savings. I mean, imagine what people can do with that money. Once again, what is the message here? Different couples, they needed the same income, but the difference is a couple B, they took a different route to get there and they're paying nothing in taxes. That is absolutely huge. And now let's talk about this, Tommy. I really want to stress this point because when you take a look at why, real quick here. So in this example, the wife took her benefit right away and then the husband waited, okay, in terms of couple B. Why would we do that? There's 3 reasons why we would do it. Number 1, we want to take stress off of that 401k because what is the number 1 fear of retirees?
Running out of money.
Running out of money, right? We don't want to do that. Social Security is a retirement paycheck for life. Number 2, statistically, right? Our gals seem to outlive us, right? I mean, statistically speaking. And so when we lose a spouse, the widow or widower will get the higher benefit, but we're going to lose the lower Social Security. And number 3, which is what we're talking about right here, tax efficiency, tax smart, saving money in taxes. So again, if we're encouraging somebody to delay, I better have a darn good reason why. This is a pretty good reason why, right?
It makes a pretty good case, especially if you're.
I'd say so.
Especially if you're taking advantage of some planning opportunities typically between that retirement date and the Social Security election date, a window where you can review. Later we'll talk about Roth conversions, but getting that money to that 1099 never bucket.
Let's keep moving. So now we talked about married filer joint. Let's now talk about single filers, Tommy. Let's go through this example.
They have, at this point, a lower standard deduction, hit the income brackets higher. So an individual who needs that same $60,000 has a $35,000 Social Security benefit, needs $25,000 from the IRA to get to that same $60,000. In this case, they owe about $2,400 in federal taxes.
That's still not bad. I mean, it just shows you the power of Social Security, in terms of how it's taxed. But again, we're just at the tip of the iceberg here. I mean, and Tommy, this is also why we offer that 15-minute retirement review. I mean, I believe it's been very effective for people because, they're able to call us, ask us those questions, whether it's about taxes, which is what, they're asking about, or their 401k, their Social Security, or maybe just, retirement in general.
It's easy to get some quick information or guidance on what makes sense for you, what works within your plan, easily within those calls.
Absolutely. So we do encourage you all to take advantage of that 15-minute retirement review. We are truly here to help you. Next, we're going to keep moving. We're going to talk about Roth conversions. We're going to talk about withdrawal rates. There's a lot of things we're still going to stay on. Make sure you stay with us right after the break. I'm Cameron McCarty, talk show host, financial advisor, and business owner.
Did you know Cameron is happily married, raising 4 kids, thinks he's a news anchor?
I don't know about that one.
But did you also know he helps people get retirement ready? He can help you too.
That's why I'm coming to you on the weekends, getting you answers to your retirement questions.
Don't miss him on Retire Vivid, every weekend on ABC.
We are at the finish line here in terms of tax efficiency when it comes to planning. In terms of retirement, we're going to talk about withdrawal order and in a big one, Roth conversions. But let's first stay on withdrawal order first, Tommy, because this does play an important role, not only for retirement income, but also a tax plan that's laid out for you.
Yeah, in segment A, we talked about the tax bucket. So in this example, 62-year-old has $200,000 in that taxable account, $250,000 in the traditional or pre-tax 401k IRA, $50,000 in a Roth IRA. And so he's considering, withdrawing, do I take, all my capital gains and withdraw the taxable account first, and then the IRA, and then the Roth, or do you withdraw proportionally? And so you can see the tax difference between the two examples. So in the first one, in this example, he has $25,000 a year in Social Security. These accounts growing 5% annually and needs an after-tax income of $60,000. So first example, he takes all the taxable account and then the traditional account and then the Roth account, owes an estimated $57,840 over the lifetime. You can see in the middle there, when that traditional IRA is withdrawn, you get a tax bump. In the second example, he withdraws proportionally to get to that $60,000 after-tax income. Spreading the taxes over the lifetime of those withdrawals, you can say there's an estimated, about 39% reduction in taxes, going from over $57,000 to about $35,000 in taxes owed over that time frame.
If there's anything that you all are picking up right now, this is powerful stuff, because this is one of the big questions that people ask us. They have these different tax buckets, but where do you pull from? This is what I'm talking about here, because again, this is just a scenario. The question is what makes sense for you. But if we're able to save that amount of money in taxes, I get excited about that. That is absolutely huge.
It is. It's a very real savings, and it's less money you have to take out to cover your annual income needs plus taxes. So it makes a big difference.
That's right. Because once again, the one thing we don't want to do is this, especially if there's a car. This could be a number of different examples. So many times people call in, they'll say, "Hey, Cam, I need money for a car," or some big ticket item, right? The one thing we don't want to do is move up into another tax bracket, right? So if we're in the 12% tax bracket, how do I stay there? Right, in terms of the different withdrawals that we can do, a withdrawal order, so I don't pop into that 22% tax bracket. So once again, it's just planning. But unfortunately, from what we've seen, a lot of people just don't do it. They say, yeah, I'm just going to pull from this. Okay, but why? Does that make sense tax-wise? Is that tax smart? That's what we're doing this show about in terms of taxes in retirement.
We spend a lot of time talking about typically the break between the 12 and the 22% tax bracket. Marginal income rate, that's a 10% bump on money that goes into the 22% bracket. And it's a 15% bump on those qualified dividends and long-term capital gains. You go from 0 in the lower brackets to 15% in that next bracket. And so it can be a very real savings to evaluate and be tax smart about your withdrawals.
Absolutely. And that's also why I believe we meet with our people so often, because it's important that we stay on this all the time. Now, we just talked about doing proportion. Do we do it one at a time? It can show you that it could potentially be a tax savings over the course of your retirement. But now let's move on to the big one. Roth conversions, right? I'm a huge fan of this. I know you are too. The question is how do you get into the Roth? So I'm going to go through an example just so that people can see in terms of a story of what we're trying to look for when it comes to a conversion. So let's go through this. Okay, so here we got an example of a husband and wife. We got the tax brackets. We got the 10, the 12, 22, 24. These are the federal marginal rates as of right now. We'll see what happens in the next few years with the Tax Cuts and Jobs Act as that's set to sunset. Another day, another conversation. Okay, so here we got both the husband and wife, they're working, and you can see that that's W-2 income. So that's ordinary income, and they are in the 22% tax bracket. Then we fast forward, and the husband's still working in this case, and the wife retired. She took her Social Security, and again, as you know, Tommy, I mean, they're still working because what do we all need?
Healthcare.
We need health insurance, right? And so age 65 is Medicare. But the wife retires and the husband's still working. But notice something, they dropped from the 22% tax bracket down to the 12. Then we fast forward, the husband retires, they don't have a pension, they're both pulling from their traditional IRAs and they've both taken their Social Security. But they're still in the 12% tax bracket. But fast forward, look at this. They were good savers. They weren't pulling out enough. And then boom, at 73, the required minimum distribution kicked in, popping them into those higher tax bracket. So when we talk about this, Tommy, and we say, hey, winter tax is on sale, this is the stuff we're looking for.
Yeah, it's very important to review what you need for income now, and also consider where you may be going. If that IRA continues to grow, if the income need stays fixed, regardless of what you need for that income, your RMD is going to kick in at some point. And so we mentioned earlier, the Roth IRA right now does not have the required minimum distribution, doesn't have that requirement. Reviewing when taxes are on sale for you, it's something that we run into with a lot of clients and they really seem to like it.
Tommy, this is why I love what I do. I mean, whenever you and I are able to show people this in terms of how to save money in taxes and do forward thinking with them, not only are they excited, but we're really changing the landscape in terms of what they're looking at for the future in tax.
Absolutely. Our clients don't mind paying taxes. They just don't want to pay any more than they have to.
That about sums it up right there. Thank you all for listening. I hope you learned something today. I mean, keep in mind, remember, we are on every weekend helping you get retirement ready. We'll catch you next time right here on Retire Vivid.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.
Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.